Imagine waking up, uh, logging into your brokerage account and deciding to drop $11.9 million on a single stock,
Oh, wow.
right? And I mean, not client money, your own personal wealth. That is exactly what the CEO of a highly controversial healthcare company just did.
Which creates a massive dilemma for the market,
It
honestly.
really does. So is this healthcare stock a hidden gem that's, about to break out of a major technical resistance level? Or is it just a classic value trap waiting to catch retail investors who are simply chasing momentum?
That is the multi-million-dollar question.
Literally. And that is what we are answering for you today. But before we dig into the charts, the frankly bizarre financial paradoxes, all this insider money, you know the drill.
Yep, here it comes.
You have to like this video, subscribe to the YouTube channel, and I'm making it compulsory today. You have to leave your feedback in the comments right now.
Yeah.
Are you bullish? Are you bearish? Just drop your thesis down below. It's the absolute best way to join the conversation with us.
And before we pull back the curtain on this deep dive, we really need to lay down a very strict, uncompromising boundary here.
Good call.
Our mission today is to synthesize a massive stack of financial reports, technical indicators, and analyst ratings on Oscar Health Inc., trading under the ticker symbol OSCR.
Right.
However, this is purely an analytical debate. It's an exploration of complex information and market mechanics. It is absolutely not financial advice.
Exactly. Not financial advice.
We are here to look at the data objectively, explain how these systems work, and provide context. We are not here to tell you what to do with your portfolio.
That is a critical distinction. So let's start with the surface level, the immediate price action, because the market is actively turning its head toward Oscar Health.
They definitely are.
Yeah, so yesterday, April 20, 2026, the stock closed at $16.44. That represents a very solid 4.12% gain on the day, and it sits squarely in the middle of a remarkably strong short-term uptrend.
It's a significant recovery from those lows established back in March.
Yeah, and just to frame the broader battlefield for you, the 52-week range is incredibly wide. We have a low of $10.69 and a high of $23.80.
That's a huge swing.
Right. And right now, sitting in the middle of that range, we're looking at a market cap of roughly $4.89 billion.
And when you map out the structure of that recent price action, you can see the market really drawing its lines in the sand. You have very rigid, immediate support forming down near $13.40.
So that's the floor buyers are currently defending.
Exactly. And on the flip side, the immediate ceiling, the resistance level that technical traders are watching like hawks right now, is sitting at $17.30.
Okay, so $17.30 is the number to beat.
Yes, and if the buying pressure can fracture that $17.30 ceiling, the next major psychological hurdle sits right at $21 simply because, round numbers often act as mental barriers for institutional and retail traders alike.
Well, I'm looking at this chart, and it's recovering so aggressively from the March lows, and it's undeniably catching a bid. But I have a hard time accepting that this is just retail traders playing with momentum or some random algorithm fluctuation,
Oh, absolutely not. The volume and conviction required to move a nearly $5 billion company tells a very specific story.
Which brings me back to my opening point. Retail traders are looking at this bounce, but who is actually buying at these levels to cause this kind of sustained upward pressure?
Well, what's fascinating here is that the loudest, most aggressive signal isn't coming from a hedge fund accumulating shares quietly.
Right.
And it's not a retail subreddit trying to force a rally. It is coming from the absolute top of the corporate ladder. In early April 2026, Oscar Health CEO Mark Bertolini stepped into the open market and purchased $11.9 million worth of shares.
Okay, but let me play devil's advocate for a second here.
Go for it.
We see executives buy and sell stock all the time, right? Sometimes it's just a PR stunt to project confidence. Or maybe they're just exercising options they were already granted as compensation. Why should a retail investor care about this specific transaction?
Well, it comes down to the fundamental difference between insider selling and insider buying, and the sheer scale of this particular purchase.
Right. $11.9 million is no joke.
Exactly. In the financial world, insider selling carries a lot of noise. An executive might sell shares because they're buying a new house or paying a massive tax bill or simply diversifying their portfolio.
It doesn't necessarily mean the company is tanking.
Right. But insider buying, especially an open market purchase to the tune of nearly $12 million, that cuts through all the noise.
Yeah, you don't do that to pay a tax bill.
Definitely not. There is traditionally only one reason an executive deploys that level of their personal after-tax wealth into their own company.
They believe the stock is fundamentally undervalued and going up.
Exactly. He isn't just projecting confidence, he is betting the house.
Okay, let's unpack this. Because if the CEO is throwing down $12 million of his own money, we need to look under the hood at the actual accounting to see what he is basing this conviction on.
And this is where the story gets incredibly paradoxical.
It really does. Let's look at their full year 2025 financial performance. The top-line growth is explosive. I mean, revenue grew a massive 27.5% year over year, hitting $11.7 billion.
Which is a staggering velocity of capital coming through the door for a company valued at under $5 billion.
It is. But then you look at the bottom line, and the wheels seemingly fall off. The net loss for 2025 widened to a negative $443.2 million.
Ouch.
Yeah, and that is a brutal drop considering they actually recorded a $25.4 million profit back in 2024.
Right.
Their adjusted EBITDA, which, strips out a lot of the non-cash accounting noise, still sits at negative $279.8 million. So they're bringing in nearly $12 billion but bleeding hundreds of millions.
Which brings us to the ultimate financial paradox of this deep dive. Because if you just look at the income statement, you see a company hemorrhaging money.
What?
But you have to cross-reference that with the balance sheet and the cash flow statement to understand the actual liquidity of the business.
Okay, lay it on me.
The balance sheet shows Oscar Health sitting on a fortress of $3.99 billion in total cash. They have $6.33 billion in total assets compared to $5.34 billion in total liabilities.
Wow.
Yeah, and here is the metric that confuses a lot of casual observers. Despite that massive net loss on the income statement, in 2025, they actually generated $1.06 billion in free cash flow.
Okay, I'm going to stop you right there because that fundamentally breaks the logic of basic accounting for most people.
It does seem contradictory.
I really need you to explain the mechanism here. How does a company lose nearly $500 million on paper, but simultaneously generate over $1 billion in free cash flow? It sounds like they are cooking the books.
I get why you'd say that, but it has nothing to do with accounting tricks. It is entirely about the mechanics of the health insurance business model.
Okay.
It revolves around a concept our sources cite as higher medical utilization. In the insurance sector, the timeline of cash is decoupled from the timeline of expenses.
Meaning what, exactly?
Meaning you collect the premiums, the physical cash, up front every single month. That cash goes straight into the bank, immediately bolstering your free cash flow and your cash reserves.
Okay, so cash is coming in.
Right, but you don't pay for the medical care until months, sometimes quarters later.
Oh, so they are sitting on a mountain of cash, but it's essentially a giant liability waiting to happen.
Precisely. Higher medical utilization simply means that the members who paid those upfront premiums went to the doctor, scheduled procedures, and filled expensive prescriptions at a much higher, faster rate than the company's actuarial models anticipated.
Okay, let's use an analogy to make this concrete. It sounds exactly like a wildly popular all-you-can-eat buffet.
I like where this is going.
Right, so people are paying $20 at the door, so the cash register is literally overflowing. The cash flow looks phenomenal today. But once the customers get inside, instead of eating the cheap pasta like the restaurant modeled for, everybody makes a beeline for the expensive steak and lobster.
That is the perfect mechanical metaphor. The cost of acquiring the steak and lobster providing the medical care is drastically outpacing the flat $20 premium revenue collected at the door.
Ah, I see.
So when the accountants reconcile the cost of the care provided against the premiums collected, it results in that widened net loss on the income statement.
So the cash is physically in their accounts right now, which is why free cash flow is positive.
Yes, but it is ultimately earmarked to pay for that expensive lobster.
Yeah.
It's a highly delicate balancing act of pricing your premiums accurately against how sick your population is statistically going to be.
Wow. So the fundamentals show a company literally bleeding money, but temporarily flush with cash. If human analysts are scratching their heads at that paradox, how are the purely mathematical trading algorithms and technical indicators interpreting this? Let's shift our focus to the tape, because the technicals are painting a very tense picture.
They really are.
We established that the short-term trend is bullish, but the long-term trend remains entirely neutral.
Which is really just the market's way of mathematically shrugging its shoulders. It tells you that institutional capital hasn't made up its mind about the long-term survival and profitability of this company yet.
Makes sense. However, the moving averages are showing some serious, undeniable near-term strength. The current stock price is sitting above the 20-day, the 50-day, and the 100-day moving averages.
That's a strong setup.
It is, but more importantly, it is actively testing the critical 200-day simple moving average, which is currently sitting right in that $15.88 to $16.31 zone. Plus, the MACD, the moving average convergence divergence, is showing a clear, definitive buy signal. The data shows it moved from 0.4 to 0.61, indicating building upward momentum.
We really need to explain why those specific metrics matter to the algorithms running the market.
Yeah, break it down for us.
The 200-day simple moving average is the ultimate dividing line between a macro bull market and a macro bear market for a stock. It is the average closing price over the last 200 trading sessions.
So it's the big picture.
Exactly. When a stock is below it, institutions view it as fundamentally broken. The fact that OSCR Health is testing that level from below, armed with building MACD momentum, is causing algorithms to trigger buy alerts.
And what about the MACD specifically?
Well, MACD is crucial here. It doesn't just measure the direction of the price. It measures the relationship between a short-term moving average and a long-term moving average. It's the equivalent of measuring not just the speed of a car, but its rate of acceleration.
So the acceleration is increasing.
Precisely.
Well, I hear you on the acceleration, but I am looking at the data, and there is a glaring red flag waving right in the middle of all this technical excitement.
Let me guess. The RSI.
You guessed it. The RSI, the Relative Strength Index on the 14-day chart, is currently sitting at 72.7. For anyone who doesn't look at charts all day, the RSI measures the speed and change of price movements on a scale of 0 to 100.
Right.
And anything over 70 is squarely in overbought territory. So I have to challenge this bullish momentum. With an RSI of 72.7, aren't retail traders just jumping on a train that is already running out of track? Aren't they setting themselves up to get trapped at the top?
If we connect this to the fundamental mechanics of market structure, your concern is incredibly valid.
Thank you.
When an RSI breaches 70, you are dealing with extreme exhaustion risk. Think of it like sprinting the first mile of a marathon. You might be in first place, and your speed looks incredible, but mathematically, your muscles are burning through their glycogen reserve.
You can't keep it up forever.
Exactly. In the market, an RSI of 72.7 means the buying pressure has been so intense for so many consecutive days that the buyers are quite literally running out of capital to push the price any higher. They are exhausted.
Right.
Historically, when a stock hits these levels, the elastic band is stretched to its breaking point, and you see a near-term pullback or sideways consolidation.
So buying right now is buying at the exact moment the runners are hitting the wall.
Usually, yes. However, the market rarely makes things easy, and we have to introduce the technical counter scenario here.
Okay, what's the flip side?
We have to look at the short interest. Right now, there are 26.5 million shares sold short. That represents 10.94% of the stock's float.
Let's quickly define float for the listener so we understand the gravity of that. The float isn't all the shares that exist. It is strictly the number of shares actually available to trade publicly, excluding shares locked up by insiders or major institutions.
Exactly.
Meaning nearly 11% of the accessible market is made up of people actively betting the stock will go down.
Yes, and that is a massive concentration of pessimistic money. And here is where the mechanics of a short squeeze come into play.
Oh, this is the fun part.
Right. When you short a stock, you borrow shares and sell them, hoping to buy them back later at a lower price to return to the lender. But your potential losses are mathematically infinite if the stock goes up.
Because there's no ceiling on a stock price.
Exactly. If the bullish momentum we just talked about the CEO buying, the MACD acceleration actually breaks powerfully through that $17.30 resistance ceiling, all of those short sellers are instantly underwater. Panic sets in.
They have to cover.
Yes. To close their positions and stop their losses, they are forced to buy the stock back at the current market price.
So the people betting against the stock are suddenly forced to become the most aggressive buyers.
Yes. And their forced buying pushes the price even higher, triggering more short sellers to panic and buy. It is a cascading loop.
Wow.
So while the RSI screams exhaustion, that 10.94% short interest acts as hidden rocket fuel. If a squeeze triggers, traditional overbought indicators like the RSI are fundamentally rendered useless because the buying isn't rational. It's forced by margin calls.
We have a literal perfect storm brewing here. You have massive free cash flow contradicting brutal net losses, and you have severe technical exhaustion risk pitted against a potential algorithmic short squeeze.
It's intense.
It is the ultimate setup for a debate. So let's frame the core question for you listening right now. Is OSCR an undervalued gem catching an inflection point, or is it a catastrophic value trap? Let's map out the bull case first.
The bedrock of the bull case hinges entirely on the company's own forward-looking 2026 guidance. Oscar Health is targeting between $18.7 billion and $19 billion in revenue.
That's a lot of revenue.
It is, but top-line growth isn't the story anymore. Crucially, they are projecting positive operating earnings of $250 million to $450 million.
Okay, that changes things.
Right. If management can actually execute and flip that profitability switch, suddenly the current $5 billion valuation looks incredibly cheap for a company generating $19 billion in revenue.
And they aren't just hoping for this. They have actual macroeconomic tailwinds pushing them toward that goal. The sources highlight rapid market share growth in the ACA marketplace. The Affordable Care Act exchanges.
Yep.
Plus, there was a recent jump in Medicare reimbursement rates, which acts as a massive financial injection for them.
And that acts as the direct antidote to the medical utilization problem we discussed with the buffet analogy earlier.
Right, so the government chips in for the lobster.
Exactly. Higher reimbursements mean the government is paying more money for the care their members are receiving, which helps cover the cost of that expensive medical steak and lobster.
So Wall Street must be factoring this in, right?
Oh, Wall Street analysts are aggressively pricing in this best-case scenario. Raymond James upgraded the stock to outperform with an $18 price target back on February 12, 2026.
Okay, $18.
And Piper Sandler has an even more aggressive high-conviction target of $25 a share.
A move to $25 a share sounds incredible if you're holding at $16. But let's flip the coin, because the bear case is incredibly heavy and cannot be ignored.
Definitely.
The overall consensus rating across the broader analyst community is still just a lukewarm hold or neutral, with the lowest price target sitting all the way down at $10.
It's a big drop.
Yeah, and there is a real structural volatility risk here. Oscar Health has a beta of 1.93. Let's explain what that actually means for your portfolio.
Beta is a metric that measures a stock's volatility relative to the overall market, usually the S&P 500. The broader market always has a beta of exactly 1.0. If a stock has a beta of 1.93, it is mathematically nearly twice as volatile as the market. Think of the S&P 500 as a massive, stable ocean liner.
Okay, an ocean liner.
A stock with a beta near 2 is a speedboat tethered to the side of that liner. When the ocean liner makes a slight turn, the speedboat whips around wildly in the wake. The swings both up and down are vicious. It is not a stock for an investor who wants stability.
But the volatility isn't even the scariest part of the bear case. The true bedrock of the bearish argument is a critical policy risk. We need to talk about the potential expiration of the EPTC subsidies in late 2025.
And to be totally clear, we are looking at this entirely objectively. We are stripping away all politics and simply analyzing the factual economic impact detailed in our sources.
Exactly.
So the EATTC, the Enhanced Advance Premium Tax Credits, are federal subsidies that currently lower the out-of-pocket monthly premium costs for millions of Americans purchasing insurance on the ACA exchanges. They act as a financial bridge.
So what happens if that bridge collapses? Like, what happens to Oscar Health if those subsidies are allowed to expire in late 2025?
Well, if those subsidies vanish, the out-of-pocket premium costs for middle to lower income members will instantly skyrocket.
Because they're footing the whole bill suddenly.
Right. And the internal data suggests that if that pricing shock occurs, Oscar Health could see a 20% to 30% drop in their total membership base.
That is an existential threat.
Yeah.
I mean, losing nearly a third of your paying customers almost overnight because they are simply priced out of the market.
It would be devastating.
And the terrifying part of that for the company's financials is that while 30% of the revenue vanishes, their fixed administrative costs, their headquarters, their tech infrastructure, their salaried employees remain exactly the same. The profit margins would absolutely implode.
Which perfectly frames the two extremes of this debate. The best case recovery scenario is that Oscar Health hits their 2026 profitability targets, the Medicare tailwinds offset the medical utilization costs, the subsidies are extended, and the stock rockets toward that $25 Piper Sandler target.
And the flip side.
The worst case continuation lower is that they fail to control those medical costs, the subsidies expire, a third of their members evaporate, the fixed costs crush them, and the stock cascades back down toward that $10 low target.
Man, time is literally ticking on this one, and the market is just waiting for proof to break the tie. In the short-term perspective, you are watching the immediate battlefield.
Right.
Can the buyers force the price through that $17 resistance ceiling and trigger a short squeeze? Or will that overbought RSI exhaustion drag the momentum down into a consolidation phase?
That's the short term.
And from the long-term perspective, it all comes down to the survival mechanics and hitting those 2026 profitability metrics. And the very next major catalyst, the moment the company has to open its books and show us exactly how this is playing out, is the Q1 earnings report coming up on May 6th, 2026.
That earnings call is going to be the absolute crucible. Every institutional algorithm and human analyst will be dissecting the medical utilization rates and listening intently for any forward guidance on how management plans to navigate the potential subsidy expirations.
So what does this all mean for you as you analyze this setup? We've looked at the technical exhaustion versus the short squeeze potential.
Yep.
We've unpacked the paradox of billions in cash flow against hundreds of millions in net losses, and we've weighed a $12 million insider bet against an existential policy risk. But as we wrap up, I want to leave you with one final variable that isn't showing up on the 2025 balance sheet.
Oh, what's that?
We've talked extensively about medical utilization, the unpredictability of how sick people will be. But how does the rapid advancement of predictive AI in health tech fundamentally alter this math in the coming years?
That is a massive question.
Right. If machine learning allows an insurance company to perfectly predict and proactively prevent the most expensive medical procedures before they happen, does the entire utilization risk disappear? Or does it just become an arms race against the healthcare providers?
It's wild to think about.
With the stakes this high, the battle lines drawn, and the future of healthcare technology rapidly shifting under our feet, who is going to be left holding the bag on Oscar Health, and who is walking away with the prize?